Stop loss is not actually risk management. I'm risking today's margin. It's not about how often you win, it's about how much you win and how much you lose. Go and ask yourself how many institutional traders are trading full margin. The only thing that matters is, are you profitable? You need to keep checking in with your broker.
Welcome back. Thanks for joining us. We're talking about risk management for new traders. So if you're a new trader, stay put. What happens when you don't have a risk strategy in place?
You have a very bad day. You have a very bad day. Look, losing is part of trading. You can't win every single trade. And the problem is, especially when guys have got high win rates, they think that as long as they keep winning, they'll be okay. The problem is, it's not about how often you win, it's about how much you win and how much you lose. And risk management is about making sure you take care of the downside. I would argue that you can take 50-50 trades in the market, and as long as you have solid risk management, you'll probably land up net positive and in profit. Because the secret to trading is making sure you manage the downside. If you allow your account to run to zero, you lose all your money. If you allow your account to run to 50% drawdown, you are essentially having to earn back and make 100% on the money that you've got in your account just to get back to break even. So risk management is everything. And if you don't have risk management, you will blow an account. You will find yourself on the wrong end of the market and on the wrong end of trades. Everything is going well until you're in the wrong direction. You know, if you're with the market and you're trading with the market and you're making profit, everything's great. The moment that market turns against you, if you don't have an absolute cutoff limit, you're going to blow your capital.
So when you're picking a trade, are there trades that you can identify where it's not going to be easy to manage risk? And are there trades where you would be able to manage risk easily? Is there such a thing?
No, I think irrespective of where you enter the market, even if you, like I said, if you flip a coin and enter in the middle of price action on a specific day, meaning it could go either way, as long as you have risk management in place, you will be okay. So risk management starts with this. It starts with committing to having a stop loss. If you commit to having a stop loss, and again, you can determine how much you're willing to lose, but don't lose it all. That's the point. What is the absolute limit that you are prepared to set your losses at? Let's say, for example, you're up 10% for the month. You could either set your stop loss that you back to zero, or you could set your stop loss that you at 5%. So you're willing to lose 5%. But you need to think about where you place your stop loss. You can't simply just, take a gamble at it. You also have to understand that some trades require a longer stop loss because the market is going to do this and it's going up and down before it gets to where you want it to go. Like if you're taking a very long trade in the market, you need to be prepared for drawdown in the trade. So stop loss is your first starting point, but stop loss is not actually risk management. Stop loss is if everything goes to crap. That's the backup parachute. Then it's about making sure that you have an edge when you go into trades. Like you can't just go take 50-50 trades. So I'll relate this back to roulette as an example. If you're standing at the roulette table and you put a bet on red and the table hasn't been running, you put it on red. It's a 50-50 chance, could go either way. But if you stand at that table and you wait for that table to, let's say, go red 25 times in a row, you've increased the probability that it's probably, if you put your bet down on black, there's a higher likelihood now after it having gone red 25 times in a row, it's probably going to go black. Doesn't mean it's going to, but you have an edge in that you've waited for the right things to show up. And trading is the same. If you just find good market structure, if you find good reasons to enter a trade, if you have a strong directional bias based on fundamentals, you can find a good edge in the market. From a technical point of view, if you're obeying price action and looking at market structure and points of interest and pivot points in the market, and you find levels to trade off of with confluences and reasons, I would argue, people say that's a reason to enter the trade. I would argue that that's risk management because you're increasing your edge and therefore decreasing the likelihood of the trade going against you. So that's for me is the first risk management is how you enter the trade. The second part of it is in terms of how you manage the trade. So it's great that you want to enter in over here and you think the market is going over there and you simply set it and you walk away. But what happens if something fundamental in the world changes? What happens if news comes out that is going to drive price in the other direction? What happens if, there's some economic data that gets released that drives things in the other direction? So I always say my risk management strategy, in addition to the way I enter the trade, is actively sitting and monitoring my trade. Doesn't mean I'm watching the trade every movement, but I'm keeping a close eye on my trades when I'm trading. So that if the market looks like it's hitting an area of resistance and pricing might go against me, or maybe I'm in profit and I want to be over here in profit, but I'm only over here and it looks like it's not going to go any further, part of my risk management is to take the trade off the table and take what little profit I have. The other part of risk management, as I say, is also part of actively managing the trade, is, and this is what I do, I don't actively have take profit levels unless I walk away from the market and I'm going to go do something else. Only then will I have take profit levels in the market. Generally what I do is I trail my stop loss. So I treat my stop loss as a moving take profit, but below pricing. So what I will do is I will wait for the market to move. My first thing is always to try and get my trades to break even. As soon as I get my trade to break even if I get stopped out at break even, at least I know it's a risk-free trade. So if I take 5 risk-free trades in a day and none of them work out, I don't lose anything. But if I take 5 trades where I lose, I've lost a lot of money. So for me, getting to break even is a really important part of my risk management strategy. And then it's simply a case of letting the market do its thing and going with the momentum of the market and trailing my stop loss. So the way you enter the trade, the way you manage your trade, and then obviously finally having a stop loss as a backup if everything goes to crap.
So to sum it up, the risk of all trades can be managed.
And I think the risk in every trade is exactly the same.
Okay.
I think whether you buy or whether you sell in a trade, whether you have confluences or don't have confluences, at the end of the day, a trade can go either way. And I tell people this when I'm coaching them on how to trade. Understand that when you enter the trade, you've literally thrown a live grenade into the room. And your objective is to put a pin back in it as quickly as possible. That pin is getting to break even. And obviously the stop loss is making sure you're wearing a bulletproof outfit, a bomb-proof outfit in case that thing actually goes off. That's your stop loss. So for me, irrespective of how good the trade setup is, I consider it risk putting a trade on the table. And I want to get that trade off the table as quickly as possible. So guys come in and make stupid comments on my social media saying, oh, you only trade $1 at a time in the market. I'm trading a dollar movement, but I'm trading a 20 contract for that $1 movement. And that $1 movement, whether I trade 0.01 or I trade a contract of 20, it's the same dollar movement that I'm targeting. I'm targeting the dollar movement. I'm not targeting anything else. And if I get my dollar, and that's on a 20 contract size, and that's me pulling $2,000 off in a trade, I'm happy to take that $2,000, get it off the table. The risk is gone. I've got the money. Now I can go risk that $2,000 on the next trade. Now I'm not risking yesterday's profit and yesterday's margin. I'm risking today's margin. And so as part of my risk management strategy, which is quite advanced, I actually trade multiple accounts at once. So what I will do, a lot of guys talk about hedging their risk by trading different asset classes. Like someone will trade gold US dollar, but then they'll also go and trade something else that if gold goes the other way and the US dollar pricing goes the other way, they can pick up the profits there. But that pretty much is going to put you at the same place you started at. So the way I hedge is if I'm taking long positions, what I will often do is I will scalp aggressively in the early part of the morning so that I get some profit off the table that more than covers my stop loss if I get stopped out of my long positions. And that's why I don't often lose. I don't often lose because I'm hedging on my trades.
Oh, let's talk about full margin trading. Can you just quickly touch on what that is and whether that's a good strategy?
Yeah, again, I'm going to be hated on social media for what I'm about to say about full margin trading, but it is, to me, the most idiotic thing that exists. Now, I know there are traders out there who swear by it. I know there are traders out there who don't have a lot of capital and they use full margin trading as a way to potentially generate capital fast. So they still trade on Confluence, they still do all of those things. It's not totally gambling, but what they do is they say, if I've got $1,000, what I'm going to do is I'm going to take $100 and fund the account, and when I'm ready to trade, I'm going to go all in with all my equity, so that if I get my position, I'm picking up a big amount of money, so they can potentially turn $100 into $1,000, right? And for some people it works. I mean, it definitely can work for some people. But the problem I have with it is it encourages very bad trading strategy and discipline. And for most people who are going into full margin trading as a new trader, they're going to develop a lack of discipline, a lack of understanding in the market, and they're going to generate the tendency to gamble in the market. It brings about this gambling nature. And that's why I'm trying to encourage more retail traders to gravitate more to a sort of institutional way of trading, which is a little bit more boring. It's a little bit slower. It's about paying attention to the fundamentals and using technicals for a better entry. It's about scaling down your risk on lot sizing relevant to your capital. And the guys see me trading 20 lots and they're like, that's absolutely insane. What they don't understand is how big that account is. I'm taking such a small amount of risk in those trades. In fact, I could afford to go into the trade probably 30 times over based on the equity that I'm trading. The problem is with the guys doing full margin trading, and I mean, there's even a whole like competition to this called the Full Margin Olympics in South Africa, where people are like full margin trading against each other. I get it. Trading is not the most exciting thing in the world, and this brings about a bit of excitement. It's like going to the casino a little bit, but it's not a sustainable long-term way of learning to trade. If you want to make money consistently in this market, you've got to target smaller percentages consistently every day. I would rather compound my trading accounts at 2% a day, and maybe I don't get that every single day, but maybe I get that, on a win rate of 75% or 80%. Maybe I get that most of the month. And the few times that I do lose, I'm controlling the downside, and I'm only losing on the days that I'm losing maybe 5%, maybe 3%, maybe 2% at most. And at the end of the month, I'm net positive, but I've compounded every single day. The guys trading full margin are often just looking to make a quick buck, rather than treat this as a consistent long-term opportunity to grow money. And I would challenge everybody who's doing full margin trading is going to come on these videos and argue with me. Go and ask yourself how many institutional traders are trading full margin. Go ask yourself how many banks are going full margin. Go ask yourself how many investment hedge funds are going full margin. I'll give you the answer. So what makes you think that you as an individual with infinitely less resources and infinitely less experience has got the better option for long-term investing?
I guess it's even more true if you're a beginner.
It's even worse if you're a beginner. And the problem is there are these guys on social media who really do a fantastic job at marketing it. I mean, they have, a party at NFP and everybody joins them for hamburgers and Cokes, and they go full margin on NFP. Or they go full margin on all the news events because they know it's a big opportunity. You can make money like it. There's no question about it. But again, the people making those trades don't have an actual plan on how to trade that strategy. They're not looking at it over 12 months. They're not taking their kitty and dividing it. So I've got $1,000, let me give myself 10 opportunities. If I win 4 out of the 5, I'm going to be net positive. Most of these guys are just, they take everything they have and they go all in. And it's a big problem.
So we did talk about your stop loss earlier on in this conversation.
Right.
I'm not sure if you answered with everything I needed. What are your top 5 risk management strategies, if you haven't mentioned them already?
I think,
besides the stop loss.
like I said, I think stop loss is not actually a risk management strategy. I think it's a
tool.
backup in case all goes to shit, right? So for me, risk management starts with taking a trade where I have a high degree of certainty of the direction of the trade that it's going to go in, based on many different confluences, in other words, reasons. That would be a combination of fundamentals and technicals, and of course, price action. So that's my first starting point. The next part is to make sure that I actively manage the trade. Actively keep an eye on volume, make sure that I understand if the market is obeying market structure or if it's breaking out of its trend, out of its pattern, then I need to adjust my trading strategy. Making sure that I'm trading the right strategy for the right market. Again, this will be a really great example for all the people who come and leave stupid comments on my social media saying that, oh, he only targets a dollar movement. Let me explain. If the market is ranging and it's in consolidation, I'm going to target smaller movements. If the market is trending and it's got a wider range on price, I'm going to target bigger movements. And this is what people don't understand about trading. It's about applying the right strategy to the right market at the right time. So managing the trade, making sure that if I see the trade is running out of steam, that I either decide to lock in the profits or at least trail my stop loss very tight, giving that trade an opportunity to still potentially breathe, but not take out my profits. So entering the trade, making sure that you have good management in the trade, making sure you trade with a stop loss. And then the other one I think that is probably missing is making sure that you have a solid trading plan. In other words, how much are you willing to risk? What lot sizing are you going in on? I think that's super, super important. And perhaps the one that's not spoken about by many traders, I think I'm probably the only trader that talks about this, is doing a self-assessment before you trade. I do this every single day before I trade. I do an emotional check. How am I feeling? If I'm feeling anything, I shouldn't be trading. If I'm feeling anxious, if I'm feeling nervous, if I didn't sleep well, if I'm tired, if I'm fatigued, there are days that I will choose not to trade, even though the market I know I know what it's gonna do, because I'm not in the game properly. So I think that's also a very important part of risk management that nobody talks about. In fact, as part of our resources inside the Money Tribe, we have a self-assessment questionnaire which we encourage every trader, and I do it every day, to print it out and to physically check it off. And then ask yourself those questions and figure out, are you ready to trade? It's a yes-no sort of questionnaire. And then at the end of that, to commit to following rules, to commit to risk management. So I think that is also really, really important. That self-assessment, I think, is critical. And then I'd say that the final risk is the risk management for me, again, not spoken about by probably any other trader that I've come across, is eliminating variables. For me to be in a trade, actively managing a trade, getting it at the right time, paying attention to the market, I need no distractions. You cannot effectively, consistently make profits from the market long term if you don't have absolute focus on what is happening in the market.
So we've spoken about managing risk when you're trading, but hardly anyone speaks about managing the risk when you are unable to trade. So what can you tell us about how you have prepared for the event of when you are unable to trade?
Are you saying, like, as in I would be maybe physically incapacitated and I would no longer be, my fingers aren't working, I can't trade?
Right, yes. Because no one thinks of that. They think of themselves right now and they don't have their backup plan. As part of risk management, do you think that's even a part of that conversation?
I don't think the average person making money in the Forex market is smart enough to actually think about that on a deeper level. And I know a lot of guys in the Forex space making money. I'm talking about guys who are 7-figure traders. And they are living the high life because of the money that they're making. There's very few traders that are thinking of a life beyond trading. Because when you start making money from the Forex market and you figure it out, it becomes relatively easy. It becomes almost intuitive. And I can tell you 90% of those guys are all buying shit they shouldn't be buying and not thinking about life after trading. So I think about things like this. I think about what happens if my eyesight goes. Like, what happens if I become blind? Because that's something that would affect my ability to trade. What happens if, for some reason, I lost both my arms? I know these are extreme examples, but those are the things I think of. How would I be able to execute trades? So part of my risk management is, and it's a very deep and long-winded answer, but I start with making sure that I spend a lot less than I earn. Pretty much the same principle I've lived by my whole life. I have a big focus on taking my winnings from the Forex market and putting that somewhere where I can buy income. So I don't treat my Forex money that I'm getting as income. I treat it as a vehicle to go buy something that gives me income. In other words, where can I take my Forex winnings and put it in the market that it can give me $1 million every year? And I want to try and buy as many $1 million investments that can give me $1 million net return. So I could do this. I could take 10 million from the Forex market and I could live it up right now. Or I could take that 10 million, I could go and put it into something that produces consistently, passively $1 million a year. And so I'm focused on taking Forex winnings and buying income. That's the first thing. The second thing is I am actively engaging every single day with technology to make sure that I can get my trading setups as automated as humanly possible. You can't automate everything. So I'm not talking about a Forex robot. I'm talking about research. I'm talking about data. I'm talking about analytics, pre-market checks, monitoring and managing trades actively. And a big part of that is I'm integrating AI into my trade setups to the point where I want to execute my trades on a voice command. In the event that I have no arms, I can at least tell the computer to enter and exit my trades. So I'm actively engaging AI agents as part of my setup. It's a big part of my strategy going forward. And then the other part is that I'm and this has been my story in every business I've been involved in, I'm very big on finding the business within the business. I'm making money from the Forex market and it's incredible, but there are so many levels to this market, much deeper. So people think that the Forex education is a business. It isn't. For me right now, it isn't. At some point it will be. When that thing is big enough and large enough and it's funding itself and it's doing the right thing, I will earn from that, from providing education. I deserve to earn from it because I put in the work and I'm helping people. Right now, it's not paying me money. But long term, I have a 4 or 5 year vision to grow that community to a massive base, to have it supported and being self-supported by tech and by people. And that investment will pay dividends in years to come. I'm also starting to think about how do I approach this industry from the perspective of assets under management. The more asset I have under management, and I'm not talking about trading for people, I'm talking about graduating more of my trading to larger sums of institutional money. And no, I'm not talking about prop firms, I'm not talking about private equity, I'm talking about going and getting more of the big money out there and figuring out how to bring that into my space, whilst at the same time harnessing the collective power of my community and human capital to bring about technology that will drive trades and trade opportunities into the market. So I'm thinking about the deeper business picture here. And a lot of people will not understand what I'm saying unless you've been in the industry for a very long time. But there is the trader, there is the broker, there is the liquidity provider, there is institutional capital, there is the technology. And in amongst all of that, there are probably about 100 different business opportunities. And so I want to make money from trading all the way through to everything else.
Is the choice of broker and liquidity provider part of the risk management conversation for
For the average trader,
for a
yes.
normal person?
Yeah, you need to go with a good broker because otherwise you're going to lose your money. And you need to make sure that they've got a good liquidity provider so that your trades are going to be executed and honored in a timeless manner, as well as the fact that you're going to get honored on your payments. So the liquidity provider broker question, every trader should be looking at it. It is, but that is something that you look at when you sign up with a broker, and something that you need to check in with fairly regularly. Because remember, you sign up with a broker today, a year from now they change their liquidity provider, there's a change in directors, there's a change in business strategy. You need to keep checking in with your broker.
What's the difference between a trading plan, a trading journal, and your profit and loss sheet?
Okay, so profit and loss, very easy. How much did you make? How
Okay.
much did you lose? And it's a record of that. And you look at it every day, you look at it every week, you look at it every month, you keep a running record of it. That way you know where you are in your trading journey. I talk to guys who've been trading for 7 years and they say, oh, I think I'm up more than I'm down, or I think I'm down more than I'm up. I'm saying, what is that based? What do you base it on? No, it's based on I deposited money and I withdrew money. No. You need to keep it, run it like a business. Proper set of books, profit and loss. A trade journal is something you do after your trades to reflect back on the trades that you've taken, why you took those trades, and what you can do to improve. And a trading plan is before you take the trades. How much capital are you willing to risk in the trade? What percentage of your equity are you going to put forward in the trades today? How confident are you in the trade setups that you're applying to the current market? What plan are you going to trade today? So I look at the market today and I go, it's consolidating, therefore I'm going to be scalping aggressively as opposed to looking for long trades in the market. Or I anticipate that the market is going to break into trend, and therefore I'm not going to do any scalping because I don't want to get caught on the wrong end of the market. I'm going to wait for the big breaks, and I'm going to take the breakouts, and I'm going to trade the long trades. So I have a trading plan. Most people don't have a trading plan. They come and sit in front of the charts, they do a little bit of technical analysis, and they're hitting buy and sell. They do not have a trading plan.
So of the three, which ones would belong into the risk management strategy?
All of them.
All of them. Okay.
All of them. You can't know whether you're up or down over a certain period of time unless you're actively monitoring how much you're up and down. You can't manage your risk if you're not managing your profit and loss every day. You can't improve your trading and find out where your mistakes were if you're not journaling and aggressively looking back on your trades. And you most certainly should not be trading without a plan. That's like saying, I'm going to such and such a destination. I have no map. I have no idea on direction. I don't even know if there's fuel in the car. You need to have a plan. And people are lazy because there's tools and software out there to help you do all of this. You can even be lazy doing a lot of it can be automated, and you simply getting dashboards and looking back on things, right? Except for the planning, you need to sit and do some work on it. But most traders are exceptionally lazy when it comes to these things. These things are almost a requirement for institutional traders. I mean, yesterday by the time this podcast comes out, it'll be way past when I took this trade. But yesterday I took a trade. That's my single biggest trade that I've taken to date. And before I took that trade, and I'm trading institutional money on it, I had to sit with risk management divisions. I had to sit with analysts. I had to sit with the financiers providing the finance on the trade. I had to justify and explain my methodology and work out a plan, not just on my own, but with everybody else, because it was one of the biggest trades I've ever taken. The point I'm making is I didn't just go put that trade in the market. There was planning, there was discussion, there was thinking, there was assessing risk, there was assessing upside. Most traders are not doing this. And that's the benefit of trading institutional money. You get forced to do these assessments.
The way you're speaking about it, it sounds like when an athlete is competing in like the Olympics versus someone that's just running around the track at gym. You know, there's a huge difference in what you're saying versus what a beginner is probably going through. Like where you are is completely high level.
Well, again, I mean, you know, I don't want to sound condescending when I say this, but most people getting into trading treat it like they are having fun with their friends. When I entered into trading and decided to do this, I went, how do I become the best in the world? Whether I actually accomplish that or not is actually not important. But the fact that I have the mindset to go after success, to go after becoming one of the greats, means that I have to apply myself differently to the basic trader. I've studied all of the top traders. I've studied their data. I look at how they take trades. I've studied different kinds of trading. I've been self-reflective on my own trades. I trade more like an institutional trader when I'm trading long trades, and I trade more like a very aggressive gambler when I'm scalping. And that's what's got people conflicted, because they don't understand the dichotomy between the trading. That's what makes me a very unique trader. But even when I'm scalping, what people don't know is the aggressive risk management that's behind those scalps. And so the average person coming to trading, it's like, and I always relate this back to basketball. It's like they're shooting hoops with their friends. I'm not shooting hoops with my friends. I'm here to be one of the greats. I'm here to train and think at Michael Jordan level. That means I eat right, I sleep right, I think right, I study right. And I'm up before anybody else doing my work. Because talent without hard work and discipline is meaningless. You can have all the talent in the world. If you don't apply it, it's meaningless. So do I have some talent? Absolutely. But it is my discipline and my absolute focus on trying to be in that top level that has me trading the way I'm trading. And I would argue that is why 90% of people are failing. Because they come to this thing thinking it's a game, thinking it's an opportunity, thinking it's easy money. We see the social media posts, and I'm part of that social media marketing machine where we're trying to get people interested in this industry. So we have to show people what they want to see. But if people listen to my message, which most of the other traders out there are not providing, there's a very, very small amount of traders on social media that are truly talking about the deep messages here. I'm saying things that get me absolutely hated on social media. When I say to people, technical trading for the most part is bullshit, because people don't understand that technicals exist because of shit happening in the real world. The amount of hate I get on that, the amount of people disagreeing with me and telling me I don't know what I'm talking about, because it conflicts with their desire and their belief that you can find everything you need in the charts rather than doing the deeper work. Rather than waking up at 3 a.m., if you want to be a basketball champion, and shooting hoops for 4 hours before anybody else comes to the court. I'm telling people the things that they need to hear, not the things that they want to hear. And the problem is, trading is a lot like religion. It's very hard to argue with people when they've got an absolute belief about something. I have had people sitting in front of me that have been losing money for several years in a row and are arguing trading concepts with me. And I say, buddy, I don't give a fuck about your trading concepts. The only thing that matters is, are you profitable or not? Are you making money? Are you withdrawing capital from the market? Nobody cares about your perfect technical setups. Nobody cares about your theory and your strategy in the market. If I make money from the market by throwing a coin at the wall and the coin bounces twice and I buy, and that makes money for me, it doesn't matter. The only thing matters if that thing actually makes it money and I'm making money from it. The fact that it's simple and stupid and asinine doesn't matter. The only thing that matters is, are you making money?
If you have a great strategy in place, that's fantastic. But how would someone get over the emotions to actually stick to it? Because you do find people have plans to stick to a strategy. They have a strategy, but then they never manage to stick to it because they're dealing with emotions.
I don't think it's got to do with emotions. I think it's got to do with discipline. If you take the average person starting out anything in life, go to gym. Very, very excited to be in gym initially. We get the special gear, the special shoes, we get the membership, the water bottle. And then 6 months in, we're not seeing all the results we want. And what do?
Stop.
We fall back into our old life. Or we go, no, this isn't working, so let me try something else. I'm going to give up the gym, I'm going to start surfing. I'm going to give up surfing next, I'm going to try paddle. Once I'm done with paddle, I'm going to try squash. Nothing's working. So I'm just going to keep hopping. And people do this in life. And I say what you do in life will reflect in trading to a T. The reason why most people strategy hop is they do not have the discipline to stick to a strategy. I will argue with anyone at any time and prove it that even the worst strategy, if you apply discipline to it, will eventually make money. If you have the discipline of risk management, if you have discipline of being consistent in that strategy and not changing variables, even if it is a cut strategy, it's going to eventually make money, right? As long as there is some kind of strategy, you're not just randomly every time doing something different. If you let's take a simple strategy. If you wait for pricing to be above all three moving averages and the RSI level to be between 50 and 70, and to take that trade on a bullish engulfing candle setup once it's closed, and you only do that, and you only trade that strategy, is it going to be wrong a lot of the times? Yes. But it's also going to be right a lot of the times. The problem is, most people don't apply that discipline. They don't trade after the candle is closed. The bullish engulfing candle. They get eager. They get, FOMO. They want to get in early. Then they get in and they want to get out too soon because they got a risk. They're fearing the risk. The point is, if you act like a machine, you do the same thing repetitively every single time, you will eventually get the result. I promise you that if you do 1,000 push-ups every day of your life, at some point you're going to be built like a brick shithouse. You're going to be lean, you're going to be mean, and you're going to be in shape. Most people cannot stick to doing 1,000 push-ups every day. Most people cannot stick to eating no carbs every day. Most people cannot stick to cutting sugar out of their diets. So then today they're on keto, tomorrow they're on banting, then they're on intermittent fasting, and they wonder why nothing's working. Because you're moving, you're not giving anything a chance to work. Strategy hopping is not the problem. It's a lack of discipline that's a problem. It's a lack of consistency that's a problem.
So we've identified risk management is one of the key factors for becoming a successful trader. I don't want to fall too much outside of that, but I just want to identify the key parts of it. So risk management is one.
Yeah.
What are the other parts, the main parts of trading?
A lot of the stuff is self-explanatory. So I think the one I would like to give everyone is money management. Nobody talks about money management.
Doesn't it fall under risk management?
No, because what do you do once you've made the money? Take it out of your trading account. Have the discipline not to go bigger all the time. Take some money off. Get the profits out of the market. What most people don't know about my trading journey is I put money into the market, obviously lost some money, then started making money back. And as soon as I'd got to break even, my next thing was take money out of the market from the market and trade with that money. So every trade I take and have taken since then has not been based on my money. It's not money I've gone and earned. I made that money from the market. I took my money back out. I don't have any of my money in the market at this point. The only money I have in the market is money that the market gave me. Right? That's money management. What are you doing with the money when you win? How often are you withdrawing? Are you compounding some of your accounts and using some for withdrawing?
Very tiered.
Exactly. So I have some accounts that I withdraw from on a daily basis or a weekly basis. I have some accounts that I won't draw on for an entire year because I'm compounding that money over time. Managing money is probably just as important as trading itself. And I'll give you the really, really basic way to understand this. If you earn $1 million a month, which, that's an insane amount of money, but let's just pretend, okay? And you spend 1,100,000, you're actually in a worse off position than the person who earns 100 and spends 50. You may have more shiny shit, but financially, you're worse off because you're going backwards by 100 grand every month. The other person's going forwards by 50 grand. And over time, the person earning less but with better money management is going to do better. And that's why I'm a big advocate for financial responsibility. That is why we built the Money Tribe. We didn't build the Money Tribe to teach people trading. We built the Money Tribe to teach people to get their shit together when it comes to money management. And the problem is most of the kids making money in Forex today, they zero money management.
So you've covered risk management as a key part of trading, money management as a key part.
Yeah.
Is there anything else that you would cover as a key part?
Psychology.
Psychology. Okay, so 3 main parts.
Those would be my 3 main parts. And for me, psychology is it's really a deep subject, because not only have I studied psychology to understand myself, psychology is a study of the human condition, but also a tool to understand and improve yourself. And you will find once you start to be self-aware and self-assess, the new age calls it mindful. Once you start being mindful of everything you do, you will start to understand that it is usually triggered by very specific things. And you can override those triggers with tools. So I encourage everyone to really study, if they're not going to study psychology, at least have the foresight to study your own actions and to figure out why you do certain things. And try and be better today than you were yesterday. That is my constant goal. My constant goal is just to be a little bit better today than I was yesterday. And I've been doing that pretty much my entire life. And I can tell you, I'm a better person today than I was last year. It's measurable. I can tell you I'm a better person today than I was 10 years ago. It's measurable. But it only happens if you're self-aware, and it only happens if you acknowledge the fact that the realm of psychology is an important tool in improving yourself.
That's it, guys. Thanks for joining us. Make sure you hit the subscribe button so you don't miss the next episode. And feel free to drop a comment down here. We'll see you next time.